Gillian, let me start with you, actually, on what we saw in the markets. What's driving the markets from your perspective right now?
Well, the best way to make sense of the equity markets is to recognize that a month ago, investors had a nasty shock when they realized that rates were going up. The inflation numbers have been coming much higher than expected, and the Fed has really accelerated. What we're seeing today, though, is that investors are realizing that earnings are being hurt by the underlying economic slowdown. Excuse me. And that is really what is starting to drag on people as they worry not just about inflation, but stagflation, the combination of price growth and price increases and slowing growth that frankly we've not seen since the 1970s.
So, Peter, the question everybody wants to know is how bad is it going to get? How far are we into this decline in your judgment?
I think there's two answers to that. One is how far are the markets down into their ultimate decline, and how far are we from an economic point of view into slowing growth / recession? I think on the former point, we're probably 2/3 or a little bit more of the way to a bottom in financial markets. It's likely there's another 10% in equity markets, bond markets, perhaps a little closer to their nadir. But we're going to continue to have that volatility until there is some clarity regarding how much the Fed is going to raise rates, because that really is what investors, as Gillian points out, are watching. As it relates to the economy itself, I think it's a good argument that we're already either entering a recession or in a recession. Manufacturing activity has dropped significantly. We've seen leading indicators also decline. We've seen consumption activity fall, and CEOs are beginning to predict that the second half of their economic activity for their companies is going to be a lot lower.
So, Gillian, what about that? Let me pick one of the things that Peter talked about, and that is consumption numbers. We had personal consumption numbers that really softened in the United States this week. And also, of course, we have the consumer confidence numbers, which are softening as well. That is a big driver, as we all know, of the U.S. economy. How big a risk is that at this point for the U.S. economy?
Well, there are 2 or 3 factors right now which make it incredibly hard to work out what's going on. One is the fact that, yes, you're seeing a real loss of consumer confidence, really quite staggering decline in consumer confidence. And that kind of makes sense given the scale of price shock and inflation shock. But something that we haven't really seen before in previous economic cycles is that a lot of consumers are sitting on fat cushions of savings compared to the past because of the fiscal stimulus. And I was chatting with some bank CEOs in the last few days who are saying that as of yet, they haven't really seen signs of increased defaults. They haven't yet seen signs that consumers are going bust or really in real problems, partly, of course, because there are a lot of jobs out there. Now, the bank CEOs are preparing for a lot more consumer pain further down the tracks, not least because one implication of rising interest rates is that mortgage costs are about to go up through the roof. And they're beginning to see consumers dipping into their savings cushions to try and keep themselves afloat. But there's a real time lag effect and uncertainty playing out right now. The other one is about supply chains, because so much of the price pressure right now is not driven by classic demand increases, or not just by demand increases, but by supply chain problems. And the honest answer is no one knows how long those supply chain disruptions are going to last. I was listening to Pat Gelsinger from Intel a couple of days ago saying it could be a year and a half before they really iron out the supply chain problems in computer chips. But no one quite knows how that's going to impact the wider economy, partly because companies have been increasing their stocks in recent months, and there's not a lot of visibility into how quickly they can run them down and how quickly they'll need to restock as the supply chains start to heal or not heal.
So, Peter, what about that supply chain issue? I mean, clearly, whatever it wasn't transitory in the sense of short term. And I must say, if you say a year and a half, 18 months, that seems to be a rolling 18 months. I feel like I've heard 18 months from CEOs for some time now. Why isn't the supply chain fixing itself? I mean, theoretically, in a market system, prices adjust and those sorts of problems work themselves out. Why haven't they?
Well, I think Gillian points out the supply issues in the chips world, and that has been more persistent, although it has gotten better. And you can hear that from the semi CEOs and other related entities. In the more traditional supply constraint issues, those have gotten better. So in the consumer goods that are not electronics, those companies are seeing alleviation of supply constraints, and they were able to actually satisfy demand. As you saw really in the first quarter, one of the things I thought was interesting was Target and Walmart, who dramatically adjusted their inventory prices because they ended up with way too much inventory, priced too high, and maybe even the wrong goods. So so we actually saw some price reductions. So I think we're a little bit past the acute phase of the supply constraint problem. And I think we're entering into a softer demand cycle. And Gillian points out, she's right, that there's a lot of savings, but at the lower end of the income scale, those savings are not so big. And there may also be at that part of the economy some job losses. So I'm not predicting a serious recession, but as I say, I think we're further into this growth slowdown / recession than it appears.
Gillian, what are the chances we already are in a recession? We just don't know it yet. When we had one quarter down, it could be we have a second one.
Well, of course, the problem with economic data is that data is always very backward looking, and there's no two ways about it. So it's entirely possible we are slipping into one. There are some more current series of economic metrics, like the Now series, which tries to, really amass different economic data to see what's happening in real time. And those certainly do point to quite a sharp slowdown right now. But, I've gone around talking to a number of different audiences recently of business people and policy analysts and asked them always to vote on what they think is happening. And the vast majority of people right now are braced for a mild recession, but not a steep one. And I think that probably is what the markets are pricing in right now.
Peter, I want to pick up on one of the things that Gillian referred to, and that's the housing market. We pay attention to consumers because they're so important for the economy. Goodness knows the housing market can be, as we saw in 2008, 2009. It seems to be softening. What is the risk for the economy overall from the housing market right now, given particularly mortgage rates?
Well, mortgage rates are going to go up. Housing prices are going to stop increasing and in some cases go down. That'll affect consumer wealth. That'll affect consumer consumption activities, including their savings. In other words, they may not spend their savings. We are not in a world where consumers lack for a lot of things. They have bought a number of tangible goods and durable goods over the last 18 months, given all of the stimulus in COVID. So I think that housing prices are going to be challenged here. That's going to have an effect on consumers, and that's going to add to the slowdown / recession we've been talking about. Interest rates are not coming down in the short run. You heard Powell say, we're going to take down inflation. And that means interest rates are going to rise. And plus the fact, I have to say, interest rates have for the last 12 years been at unusually low levels, not sustainable levels. So the interest rate complex in total is going to rise above where it has been for 12 years. And that's going to have an impact on the housing market as well.